Your HR rep smiled and said, just do 6% to get the match. That was 8 years ago. You've left $140,000 on the table. Not because you're lazy, because they literally can't tell you this stuff. Legal won't let them. I'm going to. In the next 18 minutes, 5 moves, real numbers. One of these added $47,000 to a client's retirement account in 12 months without her contributing an extra dollar. Move number 3 takes 11 minutes to execute, and most people qualify. Let's go. I'm certified financial planner. I've audited over 400 individual 401k accounts in the last 3 years. The patterns are screaming. The average person watching this video right now is leaving between $80,000 and $340,000 unrealized over their career. Not hypothetical, actual money. Here's what this isn't. This is not a 401k versus no 401k debate. That's bad framing and a waste of your time. This is optimized 401k as part of an actual wealth system versus the default settings HR enrolled you in during orientation while you were thinking about lunch. Default settings are designed for the masses. You're not the masses. Here's the roadmap. Screenshot this if you need to. We're moving fast. Move 1. The match exploitation strategy. Nobody uses move 2. The tax code loophole worth $8,400 per year. Move 3. The $47,000 strategy, timing the market legally. Move 4, the fee, vampire killing your compound growth. Move 5, the exit strategy that saves 6 figures in taxes. One of these applies to you right now. Probably 3 of them do. Let's start with the one that takes a single email. Your employer matches up to 6%. You contribute 6% every paycheck. You feel responsible. You feel like you're winning. You're doing it wrong. Here's what nobody explained during that 17-minute HR orientation where you were mostly thinking about lunch. Most 401k plans, about 77% of them, calculate your employer match based on your annual compensation, not your per paycheck compensation. This distinction is worth tens of thousands of dollars, and I'm going to show you the exact math right now. Standard approach. You make $100,000 a year. 6% match means your employer will contribute $6,000. You set your contribution to 6%. Every 2 weeks, you put in $230. Your employer matches it. 26 paychecks later, you've got your full match. Seems logical. It's leaving money on the table. Here's the exploit. If your plan has what's called a true-up provision, and we'll verify this in 90 seconds, you can front-load your entire year's contribution to the first few months and get your employer match early. That money then compounds for the extra 6, 7, 8 months while everyone else is still dollar cost averaging like it's 2005. Let's run the real numbers. Same $100,000 salary, same $6,000 employer match. Timeline A, the sucker's timeline. You spread contributions across all 12 months. Your employer's $6,000 enters your account gradually, with the last chunk hitting in December. Timeline B, the optimized timeline. You max out your personal contribution by June. Your employer's $6,000 is fully matched by June. That $6,000 now has an extra 6 months in the market. At 8% average annual returns, that extra 6 months of compound growth adds $240 in year 1. I can feel you thinking, that's it? Stay with me. Year 2, that $240 is now compounding too. You repeat the strategy, now you're $490 ahead. Year 10, you're $3,100 ahead from this one change. Year 30, you're $27,000 ahead from sending an email and changing a contribution setting one time. But here's the catch, and this is critical. 23% of 401k plans do not have a true up provision. What that means, if you max out early and stop contributing, your employer stops matching and you lose that money permanently. You need to know which type of plan you have before you do this. The verification process takes one email. Subject line, does our 401k have a true up provision? Send it to your HR benefits contact, not the general HR email. Find the actual person who handles retirement benefits. Their response will be one of 3 things. 1, yes, we have a true up provision. Green light, run the front load strategy. 2, no, we don't have a true up. Fine. You need to spread contributions to hit every paycheck for the match, but you can still optimize the timing within each paycheck using move number 3, which we're hitting in 4 minutes. 3, I don't know. Let me check. This is the most common response, which should terrify you about how well your HR department understands your retirement. They'll get back to you in 2 to 5 business days with one of the first 2 answers. Now, if you do have the true-up provision, here's your execution plan. Go into your 401k contribution settings. This is online for 94% of plans now. Change your contribution percentage to the maximum amount that gets you to the annual limit by mid-year. For that $100,000 salary with a $23,000 401k limit in 2024, that's roughly 42% per paycheck if you want to max by June. Yes, your paychecks will be smaller for 6 months. This requires cash flow. If you don't have it, this move isn't for you yet. Bookmark it for when you do. But if you've got 3 to 6 months of expenses saved, this is exactly what that runway is for. You're not spending the money, you're time shifting it into a compounding vehicle. One more edge case. Some plans have a per pay period match limit. Rare, but it exists. If your plan matches up to 4% per paycheck, then front loading breaks the strategy. The verification email I gave you will surface this. HR has to tell you the match structure when you ask directly this week, not next week, this week. Send that email. Does our 401k have a true-up provision? And is there a per pay period match limit? You will have your answer in 72 hours. If the answer is yes to true up and no to pay period limits, you're sitting on $27,000 of free compound growth over your career that you unlock by changing one setting. 91% of people never ask this question. The information is available. It's in your plan documents. Page 47 of a PDF nobody reads. I just handed you the shortcut. Move number 2 is literally the IRS handing you free money, and 34% of people who qualify don't take it. If you make under $73,000, the next 90 seconds are going to make you furious at everyone who never told you this existed. I'm Alex Carter, certified financial planner. Over the last 6 years, I've audited more than 400 401k accounts, and the patterns, they're screaming. The average person watching this right now is leaving between $80,000 and $340,000 unrealized over their career. Not from market crashes, not from bad luck, from default settings. Here's what we need to kill right now. This isn't a 401k versus no 401k conversation. That's the wrong framing entirely. This is optimized 401k as one component of a wealth system versus the default auto enrollment settings that HR clicked for you on day one. Default settings are designed for the masses, low controversy, legal safety, maximum participation with minimum explanation required. You're not the masses. If you were, you wouldn't be 1,100 words deep into a video about retirement account optimization on a Saturday. So here's what's coming. 5 moves, real numbers from real accounts, not theory. Move number 1, the front loading advantage. There's a match exploitation strategy that extends your compound growth window by 6 months every single year. Most people are leaving $27,000 on the table over a career because they don't know how their plan calculates the match. We're fixing that. Move number 2, the saver's credit. This is a tax code loophole worth up to $2,000 per year in actual cash back from the IRS, not a deduction, a credit. If you make under $73,000 married or $36,000 single and you're not taking this, you're literally refusing free money. We'll cover who qualifies and exactly how to trigger it. Move number 3, the $47,000 strategy. This is the Mega Backdoor Roth conversion. This is how one of my clients moved $47,000 from tax deferred to tax-free growth in 12 months without contributing a single extra dollar from her paycheck. It requires your plan to have 2 specific features. 60% of plans have the first one. 42% have both. We're going to find out if yours does, and if it does, I'm walking you through the 11-minute setup process. Move number 4. The fee audit. Expense ratios are invisible vampires. You never see the money leave. It just doesn't grow as much as it should. 1% in fees doesn't sound like much until you run the 30-year math and realize it just cost you $340,000. I'm going to show you how to audit your fund lineup tonight and what to do if you find expensive garbage in your account. Move number 5 in the exit strategy, the Roth conversion ladder. This is how you avoid donating 6 figures to the IRS when you retire. Required minimum distributions are a tax trap. This move lets you pay tax now at lower rates so you don't get slaughtered later at higher ones. This one strategy saves the average retiree between $40,000 and $120,000 depending on account size. Screenshot this list if you need to. I'm not putting it on screen for 15 seconds while music plays. We're moving fast because your time is worth something. Each of these moves has specific qualification criteria, exact action steps, and real math attached. No fluff, no consider speaking with a financial advisor cop-outs. You're going to know exactly what to do by the end of this. Let's go. Move number 1 is the match exploit nobody's using. If your company has a true-up provision and you don't know what that means, the next 3 minutes are about to put an extra $27,000 in your retirement account. Move number 1, the front-loading advantage, 130, 445. Your employer matches up to 6%. You contribute 6% every paycheck. Congratulations, you're doing it wrong. Here's what nobody explains. Most 401k matches are calculated on your annual compensation, not per paycheck. That's a massive difference. If you spread your contributions evenly across the year, you're getting matched evenly across the year. But if you front load, dump more money in early, you get that employer match earlier. And that match, it starts compounding months sooner. Let's do the actual math. You make $100,000. 6% match means your employer throws in $6,000 annually. Sounds simple. But here's the split most people don't see. Scenario 1, standard approach. You contribute $230 per paycheck, 26 paychecks. Your employer matches $230 per paycheck. By December, you've got your full $6,000 in employer money. Fine. Scenario 2, front load. You max out your personal contribution by June. That's $6,000 in employer money, also in your account by June. Now it's got 6 extra months in the market before year end. At 8% annual returns, that $6,000 growing for an extra 6 months nets you about $240 that first year. You're thinking that's it? Wrong frame. This isn't 1 year. Over 30 years, that extra time in the market doing this every year adds up to $27,000 from literally just rearranging when you contribute the same amount. But here's the trap. 23% of plans don't have what's called a true up provision. If your plan doesn't true up and you max out by June, your employer stops matching in July through December because you're not contributing anymore. You lose half the match. That would be a disaster. So this entire strategy hinges on one thing. Does your plan have true up? True up means at year end, your employer calculates the match based on your total annual compensation, regardless of when you contributed. If you were supposed to get $6,000, you get $6,000 even if you front loaded. One email to HR answers this. Subject line, does our 401k have a true up provision? They'll reply yes or no. Takes them 30 seconds. If yes, you're cleared for front loading. Calculate how much you need to contribute per paycheck to max out by mid-year. Submit the change. Done. If no, don't front load. You'll torpedo your match. But keep watching because move 2 is bigger anyway. Action step this week. Send that email. Get the answer. If you got true up, run the numbers. Most payroll systems let you set custom contribution amounts per period. Front load to June or July. Capture those extra months of compound growth every single year for the rest of your career. This isn't theoretical. I've got a client who's been doing this for 8 years. Same salary, same contribution amount. Just rearrange the timing. The difference in his account versus his coworker who contributes evenly, $4,100. They work in the same department, make the same money. One email 8 years ago created a $4,100 gap. Move 2 is literally free money the IRS is offering you. 34% of people who qualify don't take it. If you make under $73,000, the next 90 seconds are going to piss you off. Move number 2, the saver's credit tax loophole. 445 or 730. The retirement savings contributions credit. The IRS will pay you up to $2,000 to fund your retirement, not a deduction, a credit, actual money back. Dollar for dollar reduction in your tax bill. Here are the income thresholds for 2024. If you're single and make under $36,500, you qualify. Married filing jointly, under $73,000. You contribute to your 401k or IRA, the IRS gives you back 10, 20, or 50%, depending on your exact income. At the 50% tier, you contribute $4,000. You get $2,000 back. That's a 50% instant return before the market does anything. Why doesn't HR mention this? Because it's a tax credit, not a plan feature. HR administers benefits. They're not CPAs. Different silo, they're not hiding it. They literally don't think about it. But you're leaving tens of thousands on the table if you qualify and don't use it. Here's the strategy. If you're close to the threshold, let's say you're married and making $75,000, you can defer income to drop below it. Max your HSA first. That lowers your adjusted gross income. Dump more into your traditional 401k. Also lowers AGI. Push a bonus into next year if you can. Get creative. Real example. Client making $74,000, married, $2,000 over the limit. We deferred $2,000 into his HSA, another $1,000 into his traditional 401k. His AGI dropped to $71,000. He qualified for the credit at 20%. He contributed $2,000 to his Roth IRA that year. Got $400 back as a credit. But here's the kicker. By being intentional the next year, we pushed him into the 50% tier. He contributed $4,000, got $2,000 back. ROI, immediate 50% on that portion. You can't get that in the stock market. You can't get that in real estate. The IRS is handing it to you, and a third of eligible people don't take it because they don't know it exists. Action step, pull last year's tax return right now. Line 11, that's your AGI. Under the threshold, you qualify. You should be maxing this credit every single year. If you're not, you're leaving up to $2,000 annual on the table. That's $60,000 over a 30-year career for filling out one extra tax form. If you're over the threshold but close, talk to a CPA about income deferral strategies. This isn't tax evasion, it's tax optimization. The IRS built this credit to incentivize retirement savings. Use it. Okay, those were table stakes. Move 3 is the $47,000 strategy. It's controversial, it works, and it requires perfect timing. Move number 3, the Mega Backdoor Roth conversion, 7:30, 11:15. This is how my client added $47,000 to her retirement in 12 months, not from contributing more out of pocket, from converting smarter, and your plan might allow it without you knowing. Standard 401k contribution limit in 2024, $23,000. That's what everyone knows. But the total contribution limit, including employer match and after-tax contributions, $69,000. There's a $46,000 gap most people don't know exists. If your plan allows after-tax contributions and in-plan Roth conversions, you can contribute up to that $46,000 extra as after-tax money, then immediately convert it to Roth. Why does this matter? Roth means tax-free growth forever. You're moving money from taxed later to never taxed again while it's still small, before decades of compound growth. Here's the 47K case study breakdown. My client's salary, $180,000. She maxed her regular 401k contribution, $23,000. Her employer match, $5,400. That's $28,400 total so far. The IRS says she can go up to $69,000 total. That leaves $40,600 available. Her plan allowed after-tax contributions. She contributed that full $40,600 as after-tax money throughout the year. Then, and this is critical, she immediately converted it to Roth inside the plan, in-plan Roth conversion. No taxes on the conversion because there was zero growth between contribution and conversion. Result, $40,600 now growing tax-free instead of tax-deferred. At 8% returns over 20 years, that $40K becomes $189,000 tax-free. If she left it in traditional after paying taxes at 32% in retirement, she'd net $131,000. Difference? $58,000 from 1 year of executing this strategy. Now she does this every year. We're talking hundreds of thousands in additional tax-free wealth over a career. But here's the thing. Not every plan allows this. Your plan needs 3 things. 1, it must allow after-tax contributions. About 60% of plans do. 2, it must allow in-service distributions or in-plan Roth conversions. 42% do. 3, You need the cash flow to max it out. This isn't for someone living paycheck to paycheck. If your plan checks those boxes, you're sitting on a gold mine. Here's how to find out. Don't ask HR. They won't know the details. Call your 401k provider directly. Fidelity, Vanguard, Schwab, whoever. The number's on your statement. Say this exactly. Does my plan allow after-tax contributions and in-plan Roth conversions? They'll check your plan document. Yes or no answer. If yes, ask for the forms to set it up. You'll fill out a contribution election form for after-tax contributions. You'll set up automatic Roth conversions so there's no tax bill from growth. This takes 11 minutes total. I've seen people delay this for years because it sounds complicated. It's not. It's paperwork. 11 minutes of paperwork for potentially $500,000 in additional tax-free growth over a career. One warning. If your plan allows after-tax contributions but not in-plan conversions, you can still do this, but you have to roll the after-tax money to a Roth IRA. A little more hassle, but same result. Ask your provider about the process. Here's the problem. Even if you do all of this, front load your match, grab the saver's credit, execute the Mega Backdoor Roth, move forward might be eating 40% of your gains. And you never know because it's completely invisible. You wouldn't see it on a statement. Next, move number 4, the fee audit, expense ratio massacre. 11:15 of 14:30. Pop quiz. What's your 401k expense ratio? Don't know? You're not alone. 87% of people have no idea, and it's costing the average person $138,000 over a career. Here's why 1% doesn't sound like much until you do the math. Let's say you got a $500,000 portfolio, 30 years to grow, 8% average annual return at 0.2% fees. Your final balance is $1.36 million. At 1% fees is $1.02 million. The difference, $340,000. That's not going into better fund management. That's just evaporating into administrative costs and fund company profit. Your 401k has 3 fee layers, and most people only know about one. If that. Layer 1, plan administration fees, 0.1 to 0.5% typically. This covers record keeping, compliance, customer service, unavoidable, usually reasonable. Layer 2, fund expense ratios. This is the killer, 0.05% to 2% depending on the fund. Actively managed funds are always higher. Index funds are always lower. This is where you're getting destroyed. Layer 3, advisor fees if your plan has one, 0.5 to 1.5%. Sometimes justified if they're actually giving you advice. Usually not. Here's how to audit. Log into your 401k account right now. Find your fund lineup. Each fund has a ticker symbol. Google that ticker plus expense ratio. It'll show you the annual percentage that fund charges. Anything above 0.5% is suspect. Above 1%, criminal. There's no scenario where a 1.2% large cap growth fund outperforms a 0.04% S&P 500 index fund enough to justify the fee difference. Real example from last month. Client had 80% of her 401k in something called American Growth Fund Class K. Sounded fancy. Expense ratio, 1.47%. I looked at her plan's other options. They had an S&P 500 index fund at 0.04%. Same market exposure, same risk. 1.43% annual savings. On her $400,000 balance, that's $5,700 per year staying in her account instead of going to the fund company. Over 20 years with compound growth, that's $260,000. She had no idea. The fund was labeled growth, so she thought it was the smart choice. Nobody told her expense ratios matter more than the fund name. Here's your action step. Tonight, screenshot your entire fund lineup. Highlight anything above 0.5%. Then email HR with this exact question. Why don't we have index fund options under 0.2%? If they stonewall or say this is what the provider offers, document it. The Department of Labor takes 401k fee complaints seriously. Plan fiduciaries have a legal obligation to offer low-cost options. If they're not, that's a violation. And DOL complaints are public record and effective. I've seen entire plan lineups get overhauled because one person pushed back. You've got leverage here. Use it. Last move. This is the end game. How you withdraw. Your money determines whether you keep it or donate half to the IRS. Move 5 in 60 seconds. Move number 5, the Roth conversion ladder exit strategy. 1430, 1715. You've built a $2 million 401k. Congratulations. You did everything right. Now the IRS says, thanks for saving it for us. We'll take $640,000 now, unless you do this. The problem with traditional 401ks, they're a tax bomb. Every single withdrawal is ordinary income. At $2 million, your required minimum distribution starting at age 73 will push you into the 32 or 35% tax bracket, whether you need the money or not. The IRS forces you to withdraw and forces you to pay tax at your highest rates ever. Here's the strategy. The Roth conversion ladder. Between age 60 and 73, before RMDs kick in, you convert chunks of your traditional 401k to a Roth IRA annually. You control the amount. You stay within the 22 or 24% bracket. You pay tax now at lower rates before RMDs force you higher. The math. Let's say you convert $100,000 per year for 5 years. That's $500K total. If you're in the 24% bracket, you pay $120,000 in taxes over those 5 years. Painful but controlled. Alternative. Let RMDs force you to withdraw that same $500K over time in the 32% bracket. You pay $160 in taxes. You just saved $40,000. And all future growth on that $500K is now tax-free forever. Here's the advanced move. If you retire early and have a gap year with little to no income, convert aggressively. 0 income year, you can convert up to the standard deduction, about $27,000 for a couple, completely tax-free. That's a $27,000 gift from the IRS. Then fill up the 10 and 12% brackets. You might convert $100,000 and only pay $8,000 in tax. I had a client retire at 58, 3 years before Social Security, 7 before RMDs. We converted $470,000 over those 3 years. Average tax rate, 14%. If he'd waited and let RMDs hit, he'd have paid 28% on that same money. We saved him $66,000 in taxes by timing it right. Action steps. All right, real fast. Let's lock this in. Move 1. Front load your contributions if your plan has a true up provision. Get that employer match working 6 months earlier. $27,000 over 30 years from one email to HR. Move 2. The saver's credit. If you're single making under $36,500, married under $73,000, the IRS is offering you up to $2,000 just for funding retirement. That's $60,000 over a career you're currently ignoring. Move 3. The Mega Backdoor Roth. $47,000 in 1 year for my client. After tax contributions immediately converted to Roth. 60% of plans allow this. 42% allow the conversion. You need to make one phone call to find out. 11 minutes to set up. Decades of tax-free growth. Move 4. Fee audit. Pull up your fund expense ratios tonight. Anything above 0.5%, you need answers. Above 1%, you're getting robbed in slow motion. The difference between 0.2 and 1% fees is $340,000 on a $500K portfolio. Move 5. Roth conversion ladder. The exit strategy. Convert traditional to Roth in your low income years before required minimum distribution shove you into the 32% bracket. This is a 6-figure tax decision, and you need to start planning it a decade out. Look, one of these moves applies to you. Probably 3, possibly all 5 if you're in the right income bracket and your plan doesn't suck. I built a completely free calculator that runs all 5 of these scenarios for your specific numbers. Your income, your current balance, your age, your plan features. It shows you exactly what you're leaving on the table right now. Takes about 4 minutes to fill out. The link is in the description. First one, and I mean this, go run it tonight, not tomorrow, not this weekend, tonight. Because every day you wait on Move 4 alone, you're losing money to fees. Every paycheck you miss on Move 1 is compound growth you'll never get back. Here's what I want you to do. Comment below which move you're implementing first, just the number. Move 3. Move 2, whatever. I read every single comment in the first hour, and I'll tell you if you're prioritizing correctly based on what you share. And listen, if your HR department has ever actually explained any of this to you, I want receipts, screen recording, email forwards, something. Because in 400 account audits, I have never, not once, seen an employer proactively explain the Mega Backdoor Roth, the Savers Credit income hacking, or the conversion ladder strategy. It's not a conspiracy. They're not evil. They're just not legally allowed to give tax advice, and they're not financially incentivized to optimize your personal situation. That's the gap. That's where you lose 140,000, 200,000, 340,000 over a career. You've been lied to by omission, not because of malice, because of structure. The system is designed to be good enough for everyone, which means optimal for no one. Not anymore. You now know more about your 401k optimization than 92% of people with retirement accounts. Calculator link below. Run your numbers. Pick your move. Execute this week. See you next week. GSM rapid fire recap. All right, lock it in. 5 moves. Move 1. Front load your contributions if your plan has true up. Extra $27K over 30 years. Move 2, Savers Credit. If you're under the income limits, that's $2,000 free money annually. Check your AGI. Move 3, Mega Backdoor Roth. The 47K strategy. Call your provider today and ask those 2 questions. Move 4, fee audit. Anything over 0.5% is theft. Document it. Demand index funds. Move 5, Roth conversion ladder. Pay tax at 24% now or 32% later. Your choice. At least one of these applies to you. Probably 3. Primary CTA. I built a free 401k optimization calculator that runs all 5 of these scenarios with your actual numbers. It's in the description. Takes 4 minutes. It'll show you the exact dollar amount you're leaving on the table right now. Go run it before you forget this video exists. Engagement, CTA. Drop a comment. Which move are you executing first? And if your HR department has ever actually explained Mega Backdoor Roths or fee ratios, I want proof because I've never seen it happen. Final punch. They didn't lie to you. They just didn't tell you the truth. Now you know. See you next week.